Good morning and welcome to Ally Financial's third quarter 2022 earnings call. This morning, our CEO, Jeff Brown, and our interim CFO, Brad Brown, will review Ally's results before taking questions. Jen LeClaire has also joined for the beginning of today's call. The presentation we'll reference can be found on the Investor Relations section of our website, ally.com. Forward-looking statements and risk factor language governing today's call are on slide 2. GAAP and non-GAAP measures pertaining to our operating performance and capital results are on slide 3. As a reminder, non-GAAP or core metrics are supplemental to and not a substitute for U.S. GAAP measures. Definitions and reconciliations can be found in the appendix. And with that, I'll turn the call over to JB.
Thank you, Sean. Good morning, everyone. Before diving into the results, I'd like to express my sincere thanks and appreciation to Jen LeClaire, who we announced yesterday will be leaving the company over the coming months. Jen has been instrumental in our company's evolution over the past 5 years. She's been a great partner to me, but more importantly, a great leader to Ally and a great person. She's been a champion of Ally's do-it-right culture from day one, and while we're sad to see her go, we're grateful for her contributions to the company and wish her the best in this next chapter. Obviously, CFO transitions are never easy, but we have a strong bench in place that will work closely with me while we launch the search. I am thankful for both Brad and Sean stepping up in the days to come. I know Jen is excited to pursue her next chapter of opportunities, and candidly, that's hard to do while serving as a CFO. So we mutually determined now is the best time for a change and in advance of an even more fluid macro environment. Jen, thank you for everything, and I'd like to turn it over to you for a few remarks.
Great. Thank you so much for the kind words, JB. I have very much appreciated my time here at Ally, including all your support, friendship, and partnership. These last 5 years have been some of the most rewarding in my career. I'm proud of all we have accomplished as a team, and having reached both the personal and professional milestones I set out for myself, I'm proud to be leaving Ally in a stronger, better position than when I arrived. We've accomplished a number of milestones financially and operationally while continuing to expand our businesses, strengthen our balance sheet, and improve our risk management, all while fostering a deep talent bench and a robust culture. After these past 5 years, and through a global pandemic no less, I can confidently and unequivocally say we have terrific teammates, including those sitting around the table this morning, JB, Sean, and Brad. Our purpose to be a relentless ally that does it right for our customers, employees, communities, and shareholders is woven into all we do, and I'm glad I've had a part in making that come to life. Quite simply, I'm proud of what we have built together, and I'm as convicted as ever about the strength of our company and the trajectory ahead. I am also confident leaving, knowing Ally's finance leadership bench is both seasoned and extensive. We will facilitate a seamless transition, continuing to deliver for all our stakeholders as we always do. And JB and the team will continue to have me close by as an advisor to Ally. In closing, there are no words to express the pride I have in both this company, in my teammates, in the time I've spent here, and the relationships I have built. My interactions with the analyst and investor community have always been favorable, and I've deeply appreciated your support as well. And now I will hand it back over to you, JB, to discuss the results for the quarter.
Well, thank you, Jen. Appreciate you and everything. You've been a big part in our company's evolution, so thank you. And with that, let's go ahead and jump into the quarter. I'll start on page number 4. Third quarter adjusted EPS of $1.12, core ROTCE of 17.2%, and revenues of $2.1 billion reflected another quarter of solid financial results. ROTCE was approximately 12%, excluding the impact of OCI. We had several notable items impacting results this quarter and wanted to be very transparent around all the moving pieces. Similar to last quarter, and consistent with what we have been guiding, we saw strong loan growth across the company, and in particular within auto finance. We certainly recognize the tightening environment, but consumer credit underwriting is a core capability of our company, and we believe we are generating some of the most attractive risk-adjusted loans in the history of Ally. Specifically, total loans grew $4 billion in the period, driving $133 million of provision build, which I don't think was fully contemplated in street estimates. We also recorded a $136 million impairment on our investment in Better Mortgage Company, reflecting the conditions affecting the broader mortgage industry. Following the impairment, our investment has a remaining carrying value of $19 million, so this has been effectively de-risked. Within operating expenses, we recorded a $20 million charge associated with the termination of our legacy pension plan. We expect an additional impact of around $55 million within operating expenses and additional tax expense as we complete the termination in the fourth quarter. The annuity was purchased earlier in October, so this expense is certain at this point. Going forward, Ally has no remaining exposure to qualified pension plans. Given the unique nature of the pension item, the impacts are reflected in GAAP results but removed from adjusted metrics. And we recorded a valuation allowance related to foreign tax credits, which resulted in a $21 million increase in tax expense for the quarter. We expect these items will be non-recurring in nature, with the exception of the loan growth provision build. It was a bit of a noisy quarter, so we thought it would be helpful to hit these notable items at once before getting into the details on the quarter. Let's turn to page number 5 and discuss operational performance. Within auto, consumer originations of $12.3 billion were flat to the third quarter in the prior year and about $1 billion lower than the second quarter. Originated yields expanded 93 basis points quarter over quarter to 8.7%. Industry vehicle sales remain pressured, but our ability to generate strong consumer originations shows the scale of our auto finance business and depth of application flow. One other observation I would make. You've heard other CEOs make comments about pulling back from segments of the auto finance market. I think you need to look closely as to what is really happening. Prime lending continues to be a very solid space. Super prime lending is seeing very aggressive pricing from the credit unions. It makes sense that some banks don't want to chase that. The subprime market has shrunk from about 25% of the origination universe to 18%. This is a function of a lack of availability for lower price units, and that has indirectly impacted some banks' ability to originate there. Again, prime continues to perform quite well, but obviously this is where deep experience, people, and relationships matter. And further, contrary to what you also may have read about happening in the prime space, we actually observed some of our competitors lowering price in the quarter to try to capture volume. On commercial loans, we saw modest increases in new inventory levels across the marketplace, but balances remain low, and we continue to expect a prolonged normalization. We recently surpassed 7 million total vehicles sold on our Smart Auction platform. We have not typically highlighted Smart Auction very often externally, but it's a great example of how we've continued to evolve our product offerings to create value for Ally and our dealer customers. Within insurance, written premiums of $291 million were impacted by lower inventory levels and industry sales. Investment portfolio performance remained solid, but constrained by overall market performance. Turning to Ally Bank, retail deposit customers exceeded 2.6 million, expanding 6% year over year and representing our 54th consecutive quarter of customer growth. As we conveyed on last quarter's call, retail balance growth resumed, with balances increasing $2.7 billion in the quarter. Deposits currently represent 86% of funding, and we are seeing a very competitive market and larger flows to brokerage to start the fourth quarter. Our consumer engagement and product adoption trends remain compelling. Ally Home originations of $521 million in the quarter reflects broader market conditions. Equity market trends resulted in a decline in Ally Invest assets, while accounts increased 4% versus prior year. Ally Lending generated origination volume of nearly $600 million, with expansion from our healthcare and home improvement verticals. Ally Credit Card reached $1.4 billion of loan balances, and we surpassed 1 million active cardholders. And Corporate Finance continues to generate solid loan growth, with the held-for-investment portfolio reaching $9.4 billion. Let's turn to slide number 6 to discuss the consumer. Like all lenders, and especially given the uncertainty in the market, we are extremely focused on consumer health and continue to look for any early indicators of potential consumer stress. While persistent inflation remains a clear headwind, we continue to see strong balance sheets across our consumers. On the bottom left, savings account balances at Ally Bank remain elevated relative to pre-pandemic levels. We've included a view based on income level, but we look at this data across multiple dimensions, and the trends look consistent across occupation, vintage, and balance cohorts. The right side of the page shows average consumer debit spend. We've seen slight moderation from earlier this year, and spend remains up versus pre-pandemic levels. Broader financial obligations for consumers remain near record lows, enabling these spend levels while still maintaining elevated savings balances. At this stage, indicators remain solid and will remain nimble and react accordingly as the market evolves. I'd also add that within all of our lending portfolios, we've been making tactical adjustments and tweaks to our underwriting trends. This is often overshadowed by the headline numbers, but there is a tremendous amount of granular focus when we deploy credit and capital. Finally, employment remains very tight and should buoy stronger than expected credit performance relative to historical norms. So net-net, we still see a strong and well-positioned consumer, and the portfolio seasoning largely in line with expectations at this point. And with that, Brad, over to you for more of the details.
Thank you, JB. Good morning, everyone. I'll begin with detailed results for the quarter on slide 7. Net financing revenue, excluding OID, of $1.7 billion grew nearly $126 million, or 8% year over year. Performance was driven by continued strength in origination volumes and auto pricing, higher funding costs given the rapid increase in short-term rates, partially offset through our hedging position, growth in unsecured consumer products, and gradual normalization of excess liquidity over the past year. Adjusted other revenue of $359 million reflected solid performance across our insurance, smart auction, and consumer banking businesses. Revenues declined versus the prior year and prior quarter, driven by impairment of our investment in Better Mortgage that JB covered. Excluding the impact of that impairment, other revenue was consistent with our mid-400s expectations. Provision expense of $438 million reflected origination volume and the continued normalization of credit performance. Loan growth across retail auto, unsecured consumer lending, and corporate finance drove a $133 million reserve build. While CECL provisioning is a headwind for the current period, strong originations will drive attractive long-term returns. Net charge-offs in the period of $276 million remain below pre-pandemic levels. While up versus the prior year, the increase remains in line with expectations. Non-interest expense of $1.1 billion reflects continued investment in technology and higher personnel expense. As a reminder, the prior period did not include any expenses related to Ally Credit Card. As JB mentioned, the quarter also included $20 million of costs associated with the termination of our legacy pension plan. Within tax expense, results reflect a non-recurring valuation adjustment JB covered. These adjustments increased the tax rate in the quarter by approximately 5 percentage points. GAAP and adjusted EPS for the quarter were 88 cents and $1.12, respectively. Moving to slide 8, net interest margin, excluding OID, of 3.83% increased 15 basis points year over year and declined 23 basis points quarter over quarter. Given duration dynamics on both sides of the balance sheet, we expect to see some near-term pressure
but remain confident in an upper threes NIM over time. We've built a structurally enhanced balance sheet over several years that face some temporary pressure from the unprecedented pace and magnitude of the increases in short-term interest rates. Total loans and leases are up nearly $18 billion versus prior year, while the normalization of excess liquidity results in total earning asset growth of $7 billion. Earning asset yield of 5.59% grew 48 basis points quarter over quarter and 91 basis points year over year, reflecting the benefits of strong originated yields within retail auto, growth in higher yielding assets, and more than $40 billion of floating rate exposure across the loan and hedging portfolios. Retail auto portfolio yield expanded 19 basis points from the prior quarter to the 7% figure we've alluded to previously. We expect continued yield expansion due to the gradual decline in prepayment headwinds, which we've started to see in recent months, continued expansion in originated yield above 9%, and our hedging position, which added 25 basis points to the retail portfolio yield this quarter. As mentioned previously, yields expanded across our commercial and credit card portfolios as their floating nature benefits from higher rates. Looking forward, we expect continued earning asset yield expansion fueled by strong pricing in auto finance, continued disciplined growth across our newer consumer portfolios, and the benefit of higher interest rates. Turning to liabilities, cost of funds increased 77 basis points quarter over quarter and 78 basis points year over year. The increase in deposit costs reflects higher benchmark rates and a competitive direct bank market for deposits. Broadly speaking, funding costs will continue to move higher as the Fed continues with the tightening cycle, but we remain confident in our ability to manage interest expense due to our customer value proposition that goes beyond rate, core funded status, and flexibility across diverse funding sources. For the next couple of quarters, the rapid increase in benchmark rates will pressure margins as deposits initially reprice faster than earning assets. I'll cover these dynamics in detail on the next slide. Slide 9 provides detail on the drivers of near-term pressure on net interest margin and our expectations over the coming quarters. With fixed-rate retail auto as the largest asset on our balance sheet and liquid savings making up 70% of the deposit portfolio, we manage a naturally liability-sensitive balance sheet. In retail auto, we put 225 basis points of price into the market through September and 245 basis points total through last weekend. On the deposit side, our OSA pricing moved 160 basis points as of September and 175 basis points as of today. So pricing on the retail auto is 65 to 70 basis points in excess of what we've done on OSA so far. While beta on both sides has been in line with or favorable to our original expectations, because of the timing dynamics we discussed previously, increases in the retail auto portfolio yield lag increases in deposits. That will continue to be the case for the next couple quarters as the Fed is expected to move rates higher. But over time, the retail auto portfolio will continue to migrate towards the originated yield, which we expect to move well into 9%. On the deposit side, the OSA rate will move higher, but should level off once we get to a peak level of Fed funds. We provided a lot of detail on retail auto and deposits given their size, but keep in mind, most of our commercial book is floating rate. And we've talked about $3 to $4 billion of growth in unsecured lending in the medium term. Given their high margins, that growth should add 20 basis points to consolidated NIM over time. So putting all that together, we expect NIM to bottom around 350 basis points before we level off and eventually move higher. While we recognize there is focus on the trajectory, having NIM in the mid-threes when rates are expected to go up almost 500 basis points in 9 months is a reflection of the leading franchises and strong balance sheet we've built over the past several years. Lastly, on NIM, we've added additional detail on the retail auto pay fixed hedge position in the appendix. Turning to slide 10, our CET1 ratio declined to 9.3% as earnings supported $3 billion in RWA growth and $415 million in share repurchases. Last week, we announced a dividend of 30 cents per share and have completed approximately $1.6 billion in repurchases on a year-to-date basis through September. While we maintain very robust capital levels with $3.6 billion of excess above SCB requirements, given heightened macroeconomic uncertainty, we do not expect material share repurchases in the fourth quarter. Our priorities remain focused on maintaining prudent capital levels amid continued uncertainty while simultaneously investing in the growth of our businesses. Let's turn to slide 11 to review asset quality trends. Consolidated net charge-offs of 85 basis points continue to normalize in line with expectations. Comparisons to the prior year and pre-pandemic periods are influenced by the addition of unsecured lending and a corporate finance charge-off that added 10 basis points to consolidated rate and was reserved for in 2020. Unsecured lending adds an incremental 7 basis points. Retail auto performance continues to reflect a gradual normalization. Strong used values continue to benefit loss given default rates, and the normalization of peak values is consistent with our expectations. In the bottom right, 30-day delinquencies increased due to typical seasonality and a gradual normalization of consumer trends, but remain below 2019. 60-day delinquencies are equal to 2019, but we continue to see favorable flow to loss rates, helping to keep charge-offs below 2019 levels. We expect continued increases in delinquencies as consumer trends normalize post-pandemic, and we are closely monitoring additional inflationary pressures. On slide 12, we wanted to provide some additional perspective on the risk profile of the retail auto portfolio that should be helpful as you think about normalization of losses and delinquencies. Relative to 2019, our portfolio today has slightly more risk content based on our strategic shift to the intersection of prime and used. Several years ago, we began focusing more heavily on the used market and reducing our concentration in super prime, which generally has lower returns. Since making that strategic shift, we've maintained a disciplined underwriting approach. Our portfolio has gradually seasoned over that time and now reflects loss content consistent with our normalized loss expectations. As pandemic tailwinds normalize, we expect delinquencies and net charge-offs to migrate above 2019 levels. We expect normalized delinquencies of 3.4 to 3.8% versus 3.1 in 2019. And we expect losses to migrate towards 1.6%, which is 30 basis points higher than 2019. To compensate for that incremental loss content, we've added 125 basis points of price since 2019. Normalizing for benchmark rate moves, we've added 100 basis points of price to compensate for the 30 basis points of higher expected losses. And as you've heard from us in the past, the investments we've made in talent and digital tools have enhanced our servicing and collections capabilities and give us confidence in our ability to effectively manage credit in a variety of environments. On slide 13, consolidated coverage increased 3 basis points to 2.71%, reflecting growth in our retail auto, unsecured consumer lending, and corporate finance portfolios. The total reserve increased to $3.6 billion, or $1 billion higher than CECL Day 1 levels. Retail auto coverage of 3.56% increased 5 basis points and is 22 basis points higher than CECL Day 1. This includes an overlay of $19 million, or roughly 2 basis points, for potential losses tied to Hurricane Ian. We've demonstrated an ability to navigate these weather events, focusing on supporting our customers and minimizing financial impacts. Under our CECL methodology, our 12-month reasonable and supportable period assumes unemployment increasing to slightly above 4% over the next 12 months before a gradually reversion to a historical mean of about 6.5%. Moving to Ally Bank on slide 14. Retail deposits of $134 billion increased $2.7 billion quarter over quarter as growth resumed following elevated tax outflows in the prior period. Inflows from traditional banks represent the majority of growth and supports our core assumption that direct banks will become increasingly attractive as the gap between traditional and direct banks widens. Across the industry, online savings rates eclipsed 2% in September, and we saw our highest monthly growth since March of 2021. Total deposit balances increased $6 billion quarter over quarter, driven by incremental growth from broker deposits. We continue to expect modest retail deposit growth for the full year. We delivered strong customer growth, adding 51,000 new customers in Q3, our 54th consecutive quarter of growth. Since we founded Ally Bank, balance growth and retention have been foundational aspects of our retail deposit strategy, along with customer acquisition. The bottom right demonstrates a consistent trend of growth from both new and existing customers, and we continue to lead the industry with a 96% retention rate. And we operate the deposits business with less than 30 basis points of non-interest expense, a significant advantage as we think about total cost of deposits and overall efficiency. Turning to slide 15, we continue to drive scale and diversification across our digital bank platforms. Deposits continue to serve as the primary gateway to our other banking products, which enhance brand loyalty, drive engagement, and deepen customer relationships. Leveraging the strength of our brand allows us to build on current momentum across newer consumer lending products. Ally Invest continues to increase depth and strength of customer relationships at Ally Bank. Customers who have deposit and invest relationships have nearly 2 times higher balances and are less likely to attrite than standalone deposit customers. Card balances of $1.4 billion are derived from 1 million active customers, reflecting our disciplined strategy of low and grow credit lines. Ally lending balances of $1.8 billion are more than 2 times prior year levels, given momentum across healthcare and home improvement verticals. We'll continue to be deliberate, but see meaningful opportunities for accretive growth across these newer businesses and are excited for the capabilities we're building for the future. Let's turn to slide 16 to review auto segment highlights. Pre-tax income of $488 million was driven by growth in retail auto balances as well as yield and solid credit performance. The increase in provision expense versus prior periods resulted from normalizing credit performance and CECL reserve build to support $12.3 billion in consumer originations with attractive risk-adjusted returns. Looking at the bottom left, originated yield of 8.75% was up 92 basis points from the prior quarter, reflecting significant pricing actions. We put more than 245 basis points of price into the market through last week, and despite seasonality headwinds, we expect to originate above 9% in the fourth quarter. As elevated retail trade-in activity normalizes and reduces pressure on portfolio yield, we continue to expect the portfolio will migrate well into the 7s, given current originated yields. Pricing beta should be viewed through the tightening cycle, but we've been pleased with the momentum to date and remain confident in our ability to generate higher yields from here. Turning to slide 17, our leading agile platform is built to adapt to dealer and customer needs in a comprehensive manner, reflected in our performance and the multi-year growth of our dealers. We are now approaching 23,000 active dealer relationships, up 25% over the past 3 years. Our strategy remains centered on deepening these relationships and increasing application flow. In the upper right, ending consumer assets expanded to $95 billion, or nearly 7% on a year-over-year basis. Retail auto assets increased $2 billion in the quarter. Based on current market conditions, we expect more than $48 billion of consumer originations in 2022. Commercial balances ended at $16.2 billion as new vehicle supply remains pressured. Turning to origination trends on the bottom half of the page, auto volume of $12.3 billion displays our ability to generate strong flow while adding significant price in the market. Used accounted for 64% of originations, continuing to display our flexibility to adapt to market conditions, while non-prime comprised 10% of volume, consistent with our trend over the past few years. We've remained disciplined and leveraged a deliberate approach to underwriting and entrenched dealer relationships to drive strong flows. We are cognizant of the uncertainty on the horizon and remain focused on optimizing the buy box and pricing to ensure appropriate risk-adjusted returns. Turning to insurance results on slide 19. Core pre-tax income of $32 million decreased year over year from the impact of lower investment gains given the market backdrop. Total written premiums of $291 million reflected continued focus on increasing dealer engagement while still facing a headwind from lower unit sales and inventory levels across the industry. On the bottom left, we wanted to provide a real-time example of how we navigate potential loss events in ways that benefit our dealer customers and mitigate risk for Ally. Hurricane Ian was a significant storm, with insurance industry estimates calling for losses in excess of $60 billion. From an Ally perspective, we had over $1 billion of floor plan exposure in the storm's path and were able to limit expected losses to less than $4 million through proactive outreach. We continuously look for ways to differentiate our product offerings and remain a partner for our dealers as these weather events occur and disrupt their operations. Going forward, we remain focused on leveraging our significant dealer network and holistic offerings to drive further integration of insurance across auto finance. Turning to corporate finance on slide 20. Core income of $91 million reflected disciplined growth in the loan portfolio, a year-over-year increase in other revenue from a gain related to a previously restructured loan exposure, and stable credit trends. Net financing revenue was impacted by higher asset balances as well as higher benchmarks as the entire portfolio is floating rate. The loan portfolio remains diversified across industries, with asset-based loans comprising 56% of the portfolio. Our $9.4 billion HFI portfolio is up 42% year over year, reflecting our expertise and disciplined growth within a highly competitive market. Mortgage details are on slide 21. Mortgage generated pre-tax income of $19 million and $500 million of DTC originations, reflecting tighter margins and conforming production and effectively zero demand for refinancing activity. Mortgage remains a key product for our customers who value a modern and seamless digital platform. Rather than focusing on volume, we remain committed to delivering a great experience for our bank customers and compelling risk-adjusted returns, which may lead to fluctuations in origination levels over the coming quarters. Lastly, on mortgage, we provided some detail on our investment in Better referenced by JB. The investment has a remaining carry value of $19 million and generated gains in excess of the original investment. So despite the impairment this quarter, the investment has been accretive to capital. I'll close by emphasizing my confidence in Ally and our ability to successfully navigate a variety of economic environments. I'm excited to lead this transition and would like to thank Jen for her leadership over the past 5 years and wish her the very best. And with that, I'll turn it back to JB.
Thank you, Brad. Slide number 21 provides a view of the macro environment we are navigating, how we are delivering operationally, and how we are positioning for further uncertainties. As we've covered throughout today's call, operational performance remains solid, and I'm proud of our teams for focusing on controlling what we can control. Obviously, the macro backdrop is constantly evolving. As a natural, liability-sensitive balance sheet, the short term faces more pressures, but fundamentals remain very sound. Based on current forwards, the Fed funds rate is expected to increase 475 basis points this year, the most since 1980. Vehicle sales remain pressured with supply chain and production challenges yet to be fully resolved. Despite these factors, we've continued to generate attractive loan growth, and deposit growth is down across the industry given the onset of quantitative tapering and elevated tax payments in the first half of the year. Our teams have shown their ability to remain nimble, pivot as needed, and continue to deliver operationally. Full-year auto originations are expected to be around $48 billion. On the deposit side, our digital direct bank model continues to resonate in the market. We've seen steady growth in customers throughout the year, and despite new competitive forces, we still expect to generate modest full-year growth. Credit is performing in line with our expectations. Consolidated charge-offs remain under 100 basis points given the strength of our largely secured balance sheet. In addition to solid execution, we've positioned the company for a variety of economic environments. Reserve levels remain approximately $1 billion higher than CECL Day 1 and have nearly tripled since 2019. Capital levels are $3.6 billion above our SCB requirement. And again, yields on our more newly originated auto book are now well north of 8% and continuing to increase, which provides significant loss absorption capacity even in periods of elevated losses. We're disciplined on underwriting and are constantly refining the buy box to ensure we appropriately size and price for risk. And we've made meaningful investments in people and digital capabilities across our customer servicing and collections teams. So while the macro path from here remains uncertain, we have great businesses with seasoned operators and an incredible culture. Over the last decade, we have transformed all aspects of our company, and we're better positioned than ever to navigate a challenging environment. We'll stay focused on executing our strategic priorities for long-term value creation. Given the environment, we did want to share a snapshot of the fourth quarter. The outlook, particularly in the near term, remains fluid. But as we sit here today, we see NIM around 3.5%. That reflects the near-term pressure we've highlighted today. Retail yields and hedge income will be up meaningfully quarter over quarter, but it's not expected to fully offset elevated funding costs in the short term. And depending on the shape of the curve and the path of Fed's funds rate, we could be here for several quarters. We see $2 to $3 billion of loan growth expected in the fourth quarter across our consumer and corporate finance portfolios, so reserves will increase as we grow the balance sheet. Continued normalization of credit, including seasonal patterns, will result in consolidated credit losses around 100 basis points. And putting it all together, adjusted EPS is expected to be around $1 per share in the fourth quarter. I'll provide an update at the Goldman Sachs conference later this quarter, and consistent with prior years, we'll give you our insights into 2023. The ROE guide we've had out there is, again, a through-the-cycle view, and we believe largely remains intact. But obviously, the dramatic acceleration in interest rates puts some pressure on the near-term outlook. Finally, I'll close with a few comments on slide number 22. I remain incredibly proud to lead our company. Ally's purpose-driven culture is genuine and fuels our financial and operational performance. As you've heard us say, we're focused on delivering performance for all of our stakeholders, whether it's teammates, customers, communities, or stockholders. As we enter a period of uncertainty, I continue to challenge our teammates to see around corners, focus on essentialism, and adopt an owner's mindset. Ally's results and market-leading businesses demonstrate we are equipped to successfully navigate in challenging environments. We will remain focused, nimble operators, and disciplined on capital deployment, which I'm confident will drive long-term value. I know this quarter didn't hit expectations, but fundamentals remain really solid, and I hope the added transparency today gives you more of a detailed view on the various dynamics we are navigating. And with that, Sean, let's head into Q&A.
Thank you, JB. As we head into Q&A, we do ask that participants limit yourself to one question and one follow-up. Carmen, please begin the Q&A.
Thank you. One moment. Ladies and gentlemen, if you have a question, simply press *11 to get in the queue. One moment for our first question. First question comes from the line of Ryan Nash with Goldman Sachs. Please go ahead.
Hey, good morning, guys.
Hey, good morning, Ryan.
To start off, I don't know if Jen's still on the call, but I just want to say, Jen, it's been a pleasure working with you, and obviously best of luck in your new role. JB, maybe to start on credit, 4Q implies a little bit of a ramp in charge-offs. And, you've given us some color both on the delinquencies and where you see charge-offs going. I guess, can you maybe just talk about when you think these will begin to level off? And, I asked a similar question last quarter. The guide implies about $11 billion originations for the fourth quarter. And just, given market concerns, why not slow the originations a bit more, sit and see what happens with credit and the economy and take a more conservative approach, given, particularly maybe some of the newer businesses in addition to what you're seeing in auto?
Yeah, got it, Ryan. Thanks for the question. So first, leveling off on charge-offs, obviously, as we talked about throughout today's call, it's a pretty fluid environment, so hard necessarily to predict exactly. I mean, we think, mid-2023, maybe to the backside of 2023, you should start to see some stabilization there. But, some of this is obviously dependent on, how far the Fed goes, whether we can get inflation, broadly speaking, from a macro economy under control. And I think so there's a lot of unknowns at this point. What I would say, we've had out there this expected loss range of 1.4 to 1.6. Still think that's largely intact. You heard us today sort of drop the 1.4 side of that, and that's a bit by design. I mean, we see losses are going to migrate up closer to that 1.6 range through time. But I think, tied into your second point, why not pull back? Part of this is we see still these markets being very attractive. Flows, right now, Ryan, if we shocked funding costs to somewhere in the neighborhood of 4%, put lifetime losses on the auto book in excess of 2%, you're still getting an ROE of around 21% on new business and an ROA just shy of 2%. So in terms of capital deployment, in terms of continuing to serve your customers, we still feel really good about new loans that we're originating today. And, it sometimes gets lost in the big numbers when, last quarter was $13 billion, this quarter was $12 billion. We're talking about an annual number of $48-ish billion. We constantly trim the margins where we see incremental pockets of risk. I mean, the analytics behind this are very robust. We have weekly credit, conversations and buy box adjustments. So it's a very fluid environment. And, sometimes that's trimming $300 million, $400, $500 million in a quarter, but that is ongoing. So where we see pockets of risk that we say we don't like that space, we dial back. But broadly speaking, where we're playing in prime, it's still very attractive. Returns are very robust. And, I think it's important that we continue to serve our dealer customers. But I think long term, we really like the loans we're putting on the books today and think they're going to prove to be very profitable over time.
Got it. Thanks for the color. And maybe, as a follow-up, if I think about the 4Q guide, it implies a return that's less than 10% ex-OCI. And obviously there's a lot of uncertainty, but we're not in a recession yet. And I think you mentioned that, the medium-term target largely remains intact, but there's going to be pressure in the near term. So I guess, do you expect to operate around this level of profitability for the next few quarters? And I guess, given, the stock's trading less than 60% of tangible ex-OCI, where do you see the returns of this company going in 2023? And, what do you think it will take for us to get back to those medium-term return levels? Thank you.
Yeah, I think obviously with respect to the stock, it's disappointing how it's continued to trade. We're bothered by it, but I think most of this is all priced in at this point. And in fact, pretty draconian scenarios are implied, relative to future credit performance. But I think, we see ourselves, you're in the neighborhood of kind of your 10% ROE in the fourth quarter. We see that largely being the low point, and we would gradually start to increase. So, the 16 to 18, again, we've always talked about that being a through the cycle view. We still see that, is being fully intact. We're a structurally more profitable company. But I think in the near term, when you're a liability-sensitive balance sheet and you have 450, 475 basis points of Fed increases embedded over a period of 9 months, it's hard to outrun that. But I think the important point is, at some point you'll see obviously costs of deposits, which are a big driver, start to normalize. We put some sensitivities around a 75% beta from here, and that gets you to an OSA rate of, in the neighborhood of 350-ish. Whether or not we get there or not remains to be seen. Some of that's driven by competitive pressures. So at some point that starts to normalize, and your auto book starts to, all these new loans, they start to work their way through, and net, your portfolio yield is suddenly going to be much, much higher. And so we would see the exit rate in 2023 being higher. Gradually growing back to the 16 to 18 is kind of the normalized view. But I think, next year's probably in that 12 to 13+% range. And then, a couple other drivers that Brad talked about, I think the newer products, both on the consumer side, both in credit card, Ally Lending, as well as, what we're doing in the corporate finance book. That's pretty profitable business, and you take all those things together, and that should start contributing to margin expansion as well. So a lot of what you're seeing in the fourth quarter, when your NIM goes down to 350, your charge-offs are probably, approaching 100 basis points. We'll hope we'll beat that number, but, this leads to fourth quarter kind of being a floor, and it's just a bit uncertain as to how quickly you rebound from there. But hopefully you appreciate, Ryan, all the different variables and dynamics that are at play.
Appreciate all the color, JB.
You got it. Thank you. See you in December.
Thank you. One moment for our next question, please. Our next question comes from the line of Moshe Orenbuch of Credit Suisse. Please go ahead.
Great, thanks. Given that the margin, I think the margin trends were somewhat, kind of expected, maybe a touch worse, just given the fact that the Fed tightening is kind of increased faster. But can we talk a little bit about the credit normalization and what would make it, what would require you to build the reserve to a higher level than you're currently, than you're currently holding at? Given that you said that your 1 year forecast has the unemployment rate in the 4s and then moving back to a higher level, I guess, so if we think about it, what would it take for that number to be worse than what you're currently expecting?
Yeah, Moshe, thanks for the question. So I think first, overall, we feel really good about the level of coverage we have in place today. Obviously, we're up to, I think, 356, a couple basis points of that just being driven by Hurricane Ian. But, you're carrying considerable more reserves even relative to CECL day one, and certainly, if you went all the way back to 2019. So, what could cause that to change? Sometimes, with CECL, you have some interesting factors on how CECL math works. So if you got a Moody's scenario that suddenly implied unemployment rates were going to meaningfully shock higher from here, which, again, we don't necessarily think that's going to be the case, you could be forced to build a bigger reserve. But, again, I think this embedded normalization to a 6.5% unemployment rate relative to where we're at today, we feel pretty good. So we don't think that's going to transpire. But as we just talked about with Ryan, as I'm sure you're talking about, Moshe, with all your customers, there's just a lot of uncertainty about, how consumers are going to withstand, sustained inflation. Again, what we try to convey is all the things, that we see on the consumer today feel really solid. But we'll go through our normal reserving process like we do every quarter. I mean, could you see coverage tick up a point here or there just from normal BAU? Absolutely. But I think, for the most part, we feel really good about the level of reserves that are out there, and we feel we're adequately protected.
Thanks. And just as a follow-up, kind of following up, kind of on Ryan's question about, about kind of moderating originations. I guess, how do you think about it in terms of the size of the balance sheet, both in terms of capital and also just funding? I mean, to some degree, I guess I would have thought that, the more rates go up, given the fact that traditional retail banks haven't really raised their rates very much yet, that betas could be smaller, not higher. And yet, obviously, the loan growth obviously, kind of drives individual companies to kind of keep them a little bit higher to make sure they have enough funding. And I guess, so if you think about the combination of that, is that, I mean, I guess the question is, could we start to see those betas, improve before rates level off, or, how are you thinking about that currently?
Yeah, another great question. I mean, we would certainly hope so, is what I would say. But obviously, again, Moshe, as you know, there's just been a rapid actual increase in short-term rates, and even further more projected from here. You got another 175 basis points priced in. So we think, that 75% beta would be on the high side of where we would be at from here. But, you're seeing a lot of competitors and a lot of competitive pressures being out there. It's been sort of interesting to see some of the behaviors we've observed in the fourth quarter in the direct banks, and, a couple of folks now paying in excess of 3%. Frankly, that surprised us a little bit, just in terms of how aggressive some rate payers are being right there. We're trying to combat that. Obviously, we have a cash balance promo that's out there to continue, attracting high quality deposits right now. But it has been a very dynamic environment. And then the other interesting factor, I'd say, in our teams, Sean Brad and I got an update this morning. Even it's just interesting, kind of recent outflows to brokerage, which may imply, your mass consumer thinking equities are close to bottoming where they're at here, and you're starting to see bigger flows into brokerage than we've seen. So all that ends up to some degree pressuring, how much your growth, and all this starts to be a balance of how aggressive do you want to be in terms of paying on rate. But we would hope through time the beta would moderate from here. And I think that 75% again that we showed you, we would believe is more a worst case scenario than anything.
Great. Thanks very much.
Thank you, Moshe.
Thank you. One moment for our next question, please. Our next question comes from the line of Betsy Graseck with Morgan Stanley. Please go ahead.
Hi, good morning.
Hey, good morning, Betsy.
Couple of questions. Just first on the outlook for NIM. I know you mentioned the 3.5 for 4Q, and I guess I just wanted to get a sense of the push-pulls in there that would drive it either higher or lower as we go through the next couple of quarters, just in terms of, if the forward curve is moving up faster, like a Kashkari kind of rates might go higher for longer scenario. And then also just wanted to understand how you're thinking about the remarketing gains that are embedded in NIM. How does that traject throughout the rest of this year and into next? Thanks.
Yeah, you got it. So, I mean, I think with respect to NIM, it's largely going to be back to, what your assumption is around deposit costs. So similar to Moshe's question there, it's, the competitive environment remains pretty intense. We would hope beta at some point starts to slow there, but I think, that's the big driver. Obviously, on the auto side, the team's been great in terms of continuing to push pricing into the market. Flows have been really strong, really solid. Again, some of the most profitable loans we think we've ever originated, and you heard me talk about the 21% stat. So on the auto side, we're continuing to push price as hard as we can there, and again, that just takes time for the entire portfolio to season, to see that portfolio yield migrate up. But what's going to be the near-term story ultimately comes back to deposits. And then gains, about $40 million this quarter. I think we're going to be relatively in that zip code for the next couple of quarters. We don't see that being a big driver either direction here. Used car prices, as you're seeing, are starting to come off a touch. Obviously, we saw Manheim come out earlier this year. All that's embedded in our guide and in our assumptions. And so, that could slow some of the, where lessees are kind of going and capturing that gains themselves. So it could be slightly additive to us, but I don't think it's going to be a really meaningful driver from here. But, I think, we were down kind of in used 5 to 10% in the third quarter, and we still, in terms of pricing, and we obviously still had decent gains in the lease book there. So it's not going to be a huge driver, I guess, is my ultimate point, Betsy.
Okay, and then just on the outlook for the losses on the auto book, to the 1.6-ish level. I'm thinking through how declines in used car prices are going to be impacting that over the course of the next year or so, and maybe you can give us an update on some of the partners that you have exposure to, like Carvana. Thanks.
Yeah, sure. So, I think, declines in used car pricing is largely embedded in, or are embedded in that kind of 1.6 guide. I think, still, look, when we underwrite loans today, we still have that loss assumption of 1.4 to 1.6. That is consistent. I think what we're trying to do in our guide today is say, look, we recognize in light of all the macro factors, we're probably going to be on the upper end of the 1.6 range. And then in part two of your question, can you, Betsy, one more time?
Oh, yeah, sure. Just wanted to understand how your exposure is trending towards some of the partners you have, like Carvana.
Yeah, thank you. So what I would say there, obviously, we are watching Carvana closely. We engage at my level, and certainly at our head of the auto business, Doug Timmerman, with Ernie quite regularly about their journey here. What I would say, our exposure, while we do have retail commitments out there, there are price determinations there that allows us, if we don't want the paper, you can indirectly influence that by a pricing decision. But for us, we're not lending on their real estate. It's really retail exposure. And I think, as Carvana's business model is effectively to sell a car, and there's not really a lot of putback. So in terms of retail exposure to us, the paper's performing quite well. In fact, I would say on a like-to-like basis, their credit performance performs every bit as good, if not a tick better, than our own core auto dealer originated paper. So, we feel we're obviously watching them, but they've been a really good partner. And obviously they're faced with industry dynamics, inflation pressures, trying to align inventory to where demand is. But I think Ernie's done a really responsible job of kind of cleaning up operations, lowering costs, slowing its growth. But in terms of a retail flow partner, we have no complaints whatsoever about them. And consumers still like the model.
Thanks.
Thanks, Betsy.
Yep, thanks.
Thank you. And our final question, one moment, please. Our final question comes from the line of Sanjay Sakhrani with KBW. Please proceed.
Thanks. Good morning. I guess I have a question. Good morning. I have a question on new origination pricing. JB, at the outset, you talked about all the puts and takes, sort of the competitive dynamics. And I think Brad mentioned that the yield's going to move to well in excess of 9%. I'm just curious, do you guys see any change in sort of demand elasticity related to that? You mentioned also banks are pricing lower. Do you feel there's any risk to that yield as we move forward?
Sanjay, at this point, and I said it on one of the questions, we've been pleasantly surprised by our team's ability to put price in the market. I think, one other dynamic is car prices are starting to come off, honestly, that's a bigger driver in terms of a monthly payment factor relative to the absolute rate that a consumer pays. And so, these things are kind of working in tandem where, we haven't seen much pressure, but I would say, as we're having these conversations with our auto business leader and the team, I think we're probably closer to not necessarily a peak, but you're closer to a saturation point where you may see demand start to slow a bit, where consumers just don't want to see rates in excess of, call it, 10%. We're not bothered by that. Obviously, we're not out with our auto business setting a defined origination target. Again, this year we think it'll be $48 billion. Next year, I think we're planning for something several billion south of that. And so we're okay with volume coming down if the ROE isn't where it needs to be. And that's kind of the dynamic management that we go through.
Okay. And sorry if I missed this, but if as far as the share repurchase, how should we think about next year and then what you guys intend to do in terms of capital return or capital management? Thanks.
Yeah. So, obviously this year we had, our board approved a $2 billion buyback plan. We got through third quarter, have executed $1.6 billion. We have our ongoing corporate 10b5-1 in place. So we'll buy, in the neighborhood probably of 50 million-ish or so in the fourth quarter. And so, maybe we'll get around $1.7 billion by the end of this year. I think as I'm sure you knew and modeled, we had no intentions of being out there next year with a $2 billion plan. It wasn't even $1 billion plan. And so our natural expectations were for buybacks to be coming down. I think we'll still be active. Obviously, SCB is going to influence that to some degree. We're still carrying, plenty of excess capital relative to our targets. And so we will still be very prudent and efficient in buyback. But, it's not going to be, Sanjay, to the neighborhood of $1.6 billion, $1.7 billion like we did this year. I'm not even sure it'll be half of that. But, the one page I love probably more, one chart that I love probably more than any in this deck is, we have been aggressive buyers of our share from the time we IPO'd at 484 million shares outstanding to now we're down to 300 million. That's been a very disciplined, efficient users of capital. Maybe the flip side of that is, it's a lot easier to move a basis point or a penny in terms of EPS. You're down to like $4 or $5 million, which is not a lot of room in terms of the income statement to move your EPS projection. So that's one of the factors we face. But we'll keep being disciplined deployers of capital, but don't expect a magnitude like you saw this year or the past couple of years, really.
Okay, appreciate it.
You got it. Thanks, Sanjay.
Thank you, Sanjay. Thank you, JB. Showing a little past the hour here. That's all the time we have for today. If you have any additional questions, as always, please feel free to reach out to Investor Relations. Thank you for joining us.
Ladies and gentlemen, and with that, you can disconnect from the call.